In the space of 48 hours, gold and silver moved the way they usually move across an entire quarter. Gold, a market that typically creeps in tenths of a percent, fell in a single session to roughly $4,165 an ounce at the low. Silver, after racing to levels that made even veterans squint at the screen, snapped down toward the $79 to $80 zone. Those are not ordinary pullbacks. Those are the kinds of numbers that force exchanges to intervene, force funds to rebalance, and force the public narrative to change in real time. Because this was not a slow trend change you can explain away with a headline and a shrug. This was a liquidation event, the kind that happens when leverage is crowded on one side of the boat, and then the weather changes in a single announcement. And the weather changed fast. A political shock hit the rates narrative. The market began pricing the idea that the next Federal Reserve chair could be Kevin Warsh, a name associated with a tougher stance on inflation and an approach that many traders interpret as less tolerant of easy money. The dollar firmed. Rate expectations shifted. And the most heavily owned trade on the board, precious metals, suddenly had to reprice the future in real time. Here's where it gets interesting. The price collapse looked like a simple story. Higher rates, stronger dollar, metals down. Clean, convenient, easy to repeat. But the data shows something else entirely. Because while the screen was screaming sell, the plumbing underneath the market was flashing a different color. Margins were raised. Positioning flipped. Vault numbers didn't behave like panic. Official sector buying didn't vanish. And that is why this moment matters. Welcome to Channel Name. This is the place where we follow the footprints, not the noise. We focus on the numbers that don't need opinions to be powerful, and we connect the dots before they become tomorrow's obvious narrative. If you like the feeling of understanding what's happening while everyone else is still arguing about what happened, you're in the right room. And if you want, leave a comment with where you're watching from, because this market is global now, and it matters where the pressure is coming from. Now let's walk through what actually happened, with forensic detail, because this event only looks like chaos if you don't line up the sequence. On February 6, 2026, gold sold off hard, sliding toward $465 per ounce intraday. Silver fell roughly 7% into the high 70s. That drop followed an already violent prior move. The key point is the compression. This wasn't months. This wasn't weeks. This was a 48-hour window where a crowded trade was forced to meet a new narrative. And when a crowded trade meets a new narrative, the first thing to break is not the story. The first thing to break is leverage. Think about how these markets are actually held. A large share of price discovery happens in futures and derivatives, where a participant can control a large amount of metal with a fraction of the notional value posted as margin. That's efficient when volatility is low. It's explosive when volatility spikes. So what did the infrastructure do when volatility spiked? It did the one thing it always does in stress. It raised the cost of carrying risk. CME reported margin increases after the historic price plunge. Gold margins rose to about 8% from 6% for non-heightened profiles. Silver margins jumped to roughly 15% from 11%. That change sounds like a technical footnote. It's not. It's a lever. And when the exchange pulls that lever, it forces a chain reaction. Participants have to post more collateral or reduce exposure. Many reduce exposure. That means selling. And selling into a falling market creates more volatility. More volatility invites more risk controls. And risk controls invite more selling. That's the mechanical side. But it's not the whole picture. Because if this were only mechanics, you would expect the broader evidence to confirm the same story everywhere you look. Instead, you find contradictions. Let's talk about positioning, because positioning is the shadow that price casts. When the market is healthy, positioning and price tend to move with a rough rhythm. When the market is stressed, positioning changes suddenly, and that shift can tell you whether the move was conviction or forced liquidation. 4,000. That is a meaningful contraction. It points to speculative exposure being cut, not calmly rotated. In other words, it's consistent with funds exiting, not with a gentle reassessment. Now add the vault data, and this is where the red line begins to glow. LBMA's end December 2025 London Vault figures showed about 9,106 tons of gold and 27,018 tons of silver in London vaults, both rising month over month. That's not what you expect if physical demand is collapsing at the same moment paper prices are imploding. It's also not what you expect if the world suddenly decided it no longer wanted metal. The inventory picture looks steadier than the price picture. Then add the official sector. World Gold Council data for 2025 showed central banks buying 863 tons of gold, with 230 tons in the fourth quarter alone. That's not a marginal bid. That's a structural one. It tells you that even at elevated prices, official buyers were still accumulating. So now you have three simultaneous signals. 1. Futures prices plunged in a short window. 2. Leverage positioning was cut hard and margin requirements rose. That is the dislocation. Two layers of the same market telling opposite stories. And when that happens, it usually means the market is transitioning, not just correcting. To understand why, you have to place this episode inside a longer pattern, because none of this is new. The details are new, the playbook is old. In 1980, silver experienced a mania driven by a combination of inflation fear, supply anxiety, and concentrated positioning. When the structure tightened, the unwind was brutal. Prices didn't drift down, they collapsed. And after the collapse, the market entered a long period of mistrust, where participants learned that leverage could turn a sure thing into a trap. In 2011, silver ran up fast, and then the exchange raised margins multiple times in rapid succession. The result was a sharp, cascading drop that looked irrational until you remembered the mechanism. Higher margin requirements, forced selling by those who cannot post more collateral. The selling pushes prices lower, which increases risk models, which tightens risk budgets, which causes more selling. The sequence is mechanical, not emotional, but it creates emotional outcomes. In March of 2020, during the global liquidity shock, gold did something that confused people. It fell at the same time fear was rising. It was that cash became the ultimate asset in a margin crisis. Funds sold what they could, not just what they wanted to. Gold was liquid, so it was sold. Then, once the margin pressure eased, gold's trend reasserted itself. Now look at early 2026. A policy narrative shift jolts the rate path. A crowded, long in metals becomes vulnerable. Volatility spikes, margins rise, spec positions contract, prices fall hard. That is the same movie with different actors. The point is not to claim history repeats perfectly. The point is to show that when this pattern appears, the next chapter is rarely a quiet return to normal. Because after the first liquidation wave, the market has to answer a deeper question. Was the prior price level supported by genuine demand or by leverage? And if the answer is both, then the market has to decide which layer dominates next. This is the part no one is discussing. The red line is not simply a level on a chart. It's the boundary where paper risk and physical reality diverge far enough that the system has to reconcile them. Let's name the players, because markets are not abstract. They are arenas with specific institutions enforcing specific rules. You have the futures exchanges like CME that manage margin and contract specifications. You have clearing members and prime brokers that extend credit and set internal risk limits. You have large macro funds and commodity trading advisors that trade trends and volatility. You have bullion banks that make markets in spot and forwards. You have central banks that purchase for reserves. You have refiners, mints, fabricators, and industrial users. And you have the vaulting system that sits underneath all of this, turning bars into balance sheet entries. In a calm environment, these players coexist with predictable rhythms. In a stress environment, their interactions become visible. It is responding to realized volatility and risk management requirements. But the timing matters. Margin increases after a plunge often lock in the damage for the most leveraged participants. It's like tightening the belt after someone has already been punched. The people already wobbling are the ones who fall. At the same time, prime brokers and clearing members react. Their job is not to be optimistic. Their job is to survive. They may demand more collateral than the exchange requires. They may reduce credit lines. They may force position reductions. This can turn an exchange-level change into an ecosystem-wide clampdown. Then you have the funds. Trend followers see the break and flip. Volatility targeting strategies reduce exposure as realized volatility increases. Options dealers hedge gamma. All of these flows can align in the same direction, not because they share a view, but because their models share a trigger. Now put that against the longer-term buyers. Central banks are not trading daily momentum. They're adjusting reserves over years. Their buying is not a reaction to a two-day dip. It is a statement about trust, diversification, and long-term policy risk. That's why 863 tons in 2025 matters. It tells you the official sector has a different time horizon than the leveraged spec community that got flushed. So when the paper layer gets hit and the long-term layer remains, you get a tug of war. That tug of war shows up as dislocation. One dislocation is between paper prices and physical indicators. Another is between geographic narratives. When volatility spikes, the price you see is often the most liquid price, not the most representative one. Liquidity becomes king. That can make futures prices lead, even if physical markets are steady. It can also create periods where the quoted price collapses, while physical premiums remain stubborn because the supply chain cannot reprice as fast as the screen. That is why vault data matters. London vault figures at 9,106 tons of gold and 27,118 tons of silver at end December, both rising, suggest that the storage system was not draining in panic. It doesn't mean there is no stress. It means the stress may be concentrated in leveraged paper, not in immediate physical scarcity. Another dislocation is between positioning and narrative. But positioning data shows a sharp contraction in speculative net longs. That means the move was amplified by forced deleveraging. In other words, the narrative may be a spark, but the fuel is positioning. And the most important dislocation is between the short-term interpretation and the long-term pattern. Short-term interpretation says the trend is broken. Long-term pattern says liquidation events are often the mechanism by which strong hands accumulate and weak hands exit. Let me show you how the mechanism works in plain language. Imagine a theater where most seats are reserved with tiny deposits. Everyone is comfortable because the show has been great. Then someone announces that starting tonight, every reserved seat requires a bigger deposit immediately. People who can't pay more lose their seats. They don't get to negotiate. They just lose the reservation. The theater suddenly looks empty. The price of seats collapses. But the show didn't change. The rule changed. The emptiness is not lack of interest. It's inability to meet the new terms at speed. That's what margin hikes do in leveraged markets. Now, to be precise, margin hikes didn't start the move. Volatility did. The narrative shock did. But once volatility hit, margin hikes made the unwind more absolute. So what does this mean going forward? Historically, when you see a liquidation event combined with margin increases, you tend to see one of three scenarios. The conservative scenario is stabilization. Prices find a base. Positioning resets. Volatility declines. Margins eventually normalize. In that scenario, the market spends time rebuilding trust, and the next move depends on macro data and policy decisions. The moderate scenario is a rebound driven by the release of margin pressure, where the selling exhausts itself, the forced liquidations end, and price mean reverts higher as the market realizes the dip was partly mechanical. In that scenario, the key is watching whether positioning stabilizes, whether volatility drops, and whether liquidity returns. The aggressive scenario is a deeper structural break, where the liquidation reveals a broader imbalance, such as a mismatch between deliverable supply and paper claims, or a sudden tightening of credit conditions that forces more asset sales across markets. In that scenario, the initial metals drop is not the end. It's the beginning of a larger liquidity event, where everything is sold for cash until the system is forced to ease. Notice what's missing here. There's no need for prophecy. The pattern gives you a set of conditional outcomes. If margins remain elevated and volatility stays high, then paper risk stays expensive, and that tends to suppress speculative participation. If margins normalize and volatility falls, historically liquidity returns, and prices often recover from forced deleveraging lows. If official sector demand stays elevated, as it was with 863 tons in 2025 and 230 tons in Q4, then the long-term bid under gold remains present, even if it is not visible day to day. If vault inventories remain steady or rise, it suggests physical markets are not in a sudden shortage panic, which can mean that dislocation is primarily financial, not logistical. So what should be watched specifically? Watch margin notices and volatility. Watch whether exchanges increase margins again or begin to ease them. Watch positioning data for signs that liquidation has slowed. Watch the dollar and real rates, because those are the immediate narrative drivers. Watch physical indicators like vault changes and delivery activity, not because they predict daily price, but because they reveal whether the physical layer is being stressed. And watch the psychology shift. After a violent move, the market's job is to convince participants it is safe again. That process creates false starts, sharp rallies, and sudden drops. It's messy, but it's also informative, because the way price reacts to bad news after a liquidation can reveal whether selling pressure is still dominant. Now we arrive at the divide. Most people experience markets through headlines and hindsight. They see the move after it happens, then they search for a story that makes it feel inevitable. But the professionals do the opposite. They watch the constraints, they watch margin, they watch liquidity, they watch positioning, because they know the story is often a mask, and the mechanism is often the truth. This isn't about being smarter. It's about paying attention to the right layer of reality. The information gap becomes a wealth gap because institutions move when the plumbing changes and the crowd moves when the headline changes. In nearly every cycle, retail arrives late, not because retail is foolish, but because retail is shown the market through a delayed lens. This week, gold and silver didn't just move. They revealed how the system behaves under stress. They showed you what happens when a narrative shock hits a crowded trade. They showed you what happens when margins rise into volatility. And they showed you that, beneath the chaos, there are still long-term forces that don't care about a two-day chart. Now let's put hard context around those margin numbers because the percentage sounds small until you translate it into collateral. If a trader controls $100 million of notional gold exposure, a 6% margin requirement implies about $6 million of collateral. An 8% requirement implies $8 million. That's a sudden $2 million demand for cash or eligible collateral for the same position without the trader changing a thing. For For silver, the math is even more punishing. A 15% requirement on 100 million is 15 million versus 11 million before. That 4 million difference has to appear immediately or the position has to shrink. So the question becomes simple. Who can post more collateral instantly and who can't? The ones who can are the ones who survive the storm, the ones who can't become forced sellers. That's why margin hikes are not neutral. They don't protect the market in a way that is evenly distributed. They redistribute risk from the leveraged to the well-capitalized, and they do it quickly. This is also why you sometimes see a strange sequence. Prices fall, margins rise, and then prices fall again. It feels backwards, until you realize the margin hike is reacting to volatility, not predicting it. It arrives like an aftershock that knocks down buildings that were already cracked. And here's the quiet detail many people miss. 4,000, that's not just a number on a report. It implies that a meaningful portion of the trade that was pushing price higher is no longer there to defend it. In that gap, the market can overshoot. It can move farther than fundamentals would justify in a calm world because the marginal buyer has been removed. At the same time, the physical layer doesn't move at the speed of a futures screen. A vault doesn't empty in an afternoon because a chart broke a moving average. Metal has to be transported, assayed, recast, delivered, allocated, and financed. That's why vault data is a different kind of signal. When London shows 9,106 tons of gold and 27,818 tons of silver sitting in the system at the end of December, and those totals are rising, it tells you the warehouse is not in a sudden run. It suggests the storage network is functioning, even while financial positions are being violently repriced. This is the red line. When the financing layer breaks faster than the inventory layer, price can become a reflection of leverage, not a reflection of scarcity. And when that happens, the market's next phase becomes a contest between liquidation pressure and the slower, steadier forces that accumulate on weakness. That contest is also visible in timing. Central banks do not buy because they saw a candle pattern. They buy because they want less exposure to the credit system, less exposure to one currency, or more diversification in reserves. 863 tons in a year is not an impulsive decision. 230 tons in a single quarter is not a casual adjustment. It's a strategic posture. So when a strategic posture remains, while speculative leverage is flushed, the result is often a market that feels unstable short-term while becoming more structurally anchored long-term. This is why, after big liquidation events, you often see a strange calm followed by another jolt. The first jolt is the unwind. The calm is the absence of leverage. The second jolt is the return of participants who realize the market survived and begin rebuilding exposure, sometimes too quickly, sometimes cautiously. And notice how this ties back to the Warsh headline. Whether the nomination happens exactly as floated, whether the policy path evolves, whether the dollar keeps rising, those are variables. But the mechanism that turned a narrative shift into a violent move is not variable. It is structural. It is the way modern markets convert expectations into leverage and leverage into forced behavior. So when you hear someone say, "It's over, the trend is broken," or someone else say, "It's nothing, it will bounce," remember that both of those claims ignore the real question. The real question is, has the leverage been fully reset, or is it still being forced out? Because until that answer is clear, price can remain unstable, even if the long-term thesis, whatever it is, remains intact. You'll hear experts contradict each other simply because they're watching different layers of the same system. Rising rates can pressure leveraged longs in the short term. Structural buying can support the market over the long term. The dislocation is that argument expressed through price. This is channel name, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. And remember, the real question isn't whether markets will keep surprising people. The question is whether the next surprise will catch you staring at the headline or watching the numbers that move first.